Okay, today we're going to give a high-level overview of LTV, that's customer lifetime value, what it is, how we calculate it, why it's important to RevOps, how we use it in our RevOps organizations, and common myths that surround it. So what is LTV? So lifetime value, abbreviated LTV. You've probably heard this term before if you're in RevOps at all. It's sometimes called CLTV, customer lifetime value. This is the total revenue that a business expects to earn from a customer over the entire relationship. It's the revenue equivalent of the customer's full journey projected forward based on retention patterns, expansion patterns, and the gross margin available on revenue. So LTV, it's half of another metric that we talk about in another video called LTV to CAC ratio. And that determines whether your acquisition motion is profitable. Basically, are we going to make as much or more money from this customer than it took to acquire them? If it costs us $1 to acquire the customer, do we make more than $1 for them? If so, it's a sustainable motion. So it's one of the most consequential numbers in subscription economics because it sets the ceiling on how much you can spend to acquire a customer, right? If your LTV is $50,000 and your CAC is $20,000, then you have healthy unit economics. And if your LTV is $50,000 and your CAC's $40,000, you do not. Right? And the LTV calculation is what makes the analysis possible. So most companies calculate LTV inconsistently. They use it very imprecisely. As a company at our agency, RevOps HQ, we do RevOps audits every single day. And we see people using these numbers in a very imprecise and unscientific way. The marketing team, for example, uses one formula for LTV. The finance report uses another, right? The board thinks that LTV is something else, and the numbers don't actually reconcile. So then stakeholders lose confidence in the metric because they don't know, is our outbound and inbound motion sustainable or not? And decisions get made based on other metrics that are less directly determinative of your company health, like lead volume or revenue alone. And they just look at the numbers in their bank account and saying, are we going up or down, right? Because the team really can't defend their LTV math when they're pressed. And so a real customer lifetime value practice, an LTV practice, means that you have a methodology for calculating that LTV that's documented. You have a segmented calculation based on your customer segments, you have a regular refresh of that LTV, and you have an operational integration into channel allocation, meaning that you understand which channels are bringing you customers that have different LTV, right? And that also determines your pricing conversations and your customer prioritization. So here is how we calculate our LTV. So first you have simple LTV. Simple LTV is the average revenue per customer on an annual basis divided by the customer churn rate on an annual basis. So if your average customer pays $12,000 per year and your annual churn rate is 10%, then your simple LTV is $120,000. So this formula is directional and easy to compute, but ignores margin and time. Then you have a margin adjusted LTV. Margin adjusted LTV, this is your average revenue per customer times gross margin. So that formula divided by customer churn rate. So average revenue per customer times gross margin divided by customer churn rate. This means that with 80% gross margin on the same numbers, a margin adjusted LTV is $96,000. This is what actually is available to fund acquisition. So most operating LTV calculations use this formula. And then you have a discounted LTV, and this applies to a discount rate to future revenue because money in the future is worth less than money today. So the formula uses the company's cost of capital, typically 10 to 20% for SaaS, to discount projected cash flows. And discounted LTV runs 15 to 35% below margin adjusted LTV, depending on the discount rate and the retention curve. And then finally, you have expansion adjusted LTV. Expansion adjusted LTV is a little more complicated. It's your average revenue per customer times your gross margin times your net revenue retention divided by your discount rate plus your logo churn rate. So this formula accounts for expansion and is the most accurate for businesses with strong net revenue retention. And we've done another video on NRR. So for an NRR of 115%, a gross margin of 80%, and a logo churn of 8%, this produces meaningfully higher LTV than the simple formula. of just average revenue per customer divided by customer churn rate. Okay. So let's dig into an explanation for this. An LTV depends on three input streams. Okay. The first revenue stream is revenue data. So average revenue per customer segmented by tier and by tenure. So sources include the billing system for your subscription data and the CRM for opportunity and contract data. We're really looking for financial information here about your opportunity size and volume. So you want to pipe this through the data warehouse to produce a clean ARPU tables by segment. And the second stream is retention data. So this is logo churn rate, gross revenue retention, and the net revenue retention by cohort and segment. So sources for this data include your customer success platform for churn events and the CRM for renewal records. So warehouse models produce cohort retention curves that feed that LTV calculation. And then that third stream is margin data. Gross margin allocated to customer cost of service rather than to acquisition or product development. So finance teams maintain this in their financial systems. The margin allocation matters because LTV is the value available to fund acquisition, not the gross revenue. So tooling for LTV analysis generally combines a data warehouse-based modeling with a business intelligence visualization. And the planning tool integrates LTV projections into forward-looking financial models. For attribution and channel-level LTV, an attribution platform ties acquisition source to downstream revenue. The hardest LTV problem is usually data quality rather than formula choice. So how are you tracking churn? Where are you tracking churn, right? Cohort retention requires customers to be tagged with their original acquisition cohort and tracked consistently through their tenure so that you can perform appropriate channel allocation. And gross margin requires the finance team to allocate cost of service to customer revenue rather than aggregating everything together. Expansion requires a clean differentiation between expansion ARR and new logo ARR. Without these data foundations, even a sophisticated formula produces a directional number rather than an actual defensible mathematical LTV. So let's consider an example. Okay, let's consider a SaaS company with 3 customer segments, and they each have different LTV profiles. So these 3 customer segments in a traditional taxonomy are an SMB, a mid-market, and an enterprise segment. So the SMB segment has an average annual revenue of $5,000, gross margin of 80%, and an annual churn rate of 25%. So your margin adjusted LTV is 5,000 times 0.8 divided by 0.25, and that is 16,000, right? Then you have your mid-market segment, which has an average of 30,000, a gross margin of 80%, and an annual churn rate of 12%. So your margin adjusted is 30,000 times 0.80 divided by 0.12. That's 200,000. And then you have your enterprise segment that has your average annual retention revenue of 200,000, a gross margin of 75%, and an annual churn rate of 5%. So your margin adjusted LTV is 200,000 times 0.75 divided by 0.05, which equals 3 million. So your segments broken down are SMB LTV is 16,000, mid-market LTV is 200,000, and your enterprise LTV is 3 million, right? And that LTV differs by orders of magnitude across segments. And if you apply the LTV to CAC math to evaluate channel motion and fit, let's say the SMB CAC is 5,000, then the ratio is 3.2x, which is healthy. If mid-market CAC is 40,000, then the ratio is 5x, which is strong. And if the enterprise CAC is 400,000, then the ratio is 7.5x, which justifies the long sales cycle and the high touch CS investment that enterprise motions require. So now consider an investment decision. So the team's evaluating a new channel that produces, let's say, a mid-market customers at higher CAC, like 60,000. So it costs you $60,000 to acquire one new mid-market customer, but a slightly higher initial ACV, right, of let's say 35,000 and slightly better retention. So it has 10% churn instead of 12. So that new LTV becomes 35,000 times 0.80 divided by 0.10, which equals 280,000, which is better than the previous 200,000 LTV calculation for mid-market. right? And that new channel LTV of 280,000 produces an LTV to CAC ratio of 4.7x. And that channel is attractive even at higher CAC because the LTV is also higher. So without the LTV math, the higher CAC alone would have looked unattractive and the channel would have been declined, which is why it's always important to take into account LTV when we're talking about customer acquisition investments. So let's move on to bust some common LTV myths. So myth number one, most common myth is that LTV is just one number. So LTV is not what's your customer LTV. No, LTV varies by segment, by cohort, by channel, by source, and also by product line. So reporting a single LTV oversimplifies the underlying economic diversity, and that oversimplification produces decisions on partial or obscured information. The right framing is that customer lifetime value is a family of numbers, each useful for its own different questions. So channel level LTV informs marketing allocation, segment level LTV informs sales motion design, and a cohort level LTV reveals whether that business is actually improving over time. The second myth is that higher LTV is always better. Okay. Mostly true, but extremely high LTV with high CAC can produce a really long payback period that strains cash even when the unit economics technically work. So the relationship between LTV and CAC matters more than the LTV in absolute terms, right? Oh, I'm going to acquire a customer with an LTV of $1 billion, but it's going to take them 100 years to pay back to our company. It's like, well, can we support that from a cash flow or capital perspective, right? So chasing LTV without watching that ratio produces motions that look profitable, let's say on paper, but they burn cash in practice. So you got to watch LTV, CAC, and CAC payback period together. The third myth is that LTV is calculated once and then used as a foundation metric, and that's not true. LTV updates as your business evolves. So last year's LTV reflects last year's customer base, last year's retention patterns, last year's expansion behavior. This year's LTV may be meaningfully different. So a good cadence for that refresh is usually quarterly. And an annual recalibration with that fresh cohort data is usually the standard. So the fourth myth is that LTV does not matter at an early stage. But that is not true. LTV to CAC math matters at every stage. The early stage versions are rougher because the data is thinner and the cohorts haven't really matured. But the discipline of unit economics really applies from day one. Early stage companies that ignore LTV often discover that, when they get to a Series B, their economics do not work. By which point the patterns are baked in and require a difficult motion a motion change basically to fix. And then the deepest myth is that LTV is a marketing metric. LTV is a cross-functional metric. Finance, marketing, sales, and customer success all use it. Marketing uses LTV to evaluate channel investment. Sales uses it to prioritize customer segments. CS uses it to allocate engagement intensity. Finance uses it for capital planning. So treating LTV as marketing's responsibility really orphans it from the functions that need to operationalize it. RevOps owns LTV because RevOps sits at the cross-functional center of all of these departments. So how does RevOps apply this? So RevOps applies this. RevOps owns the LTV methodology and operationalization because the metric crosses every single revenue function. So the work happens in roughly 6 tracks. The first track is methodology documentation. We've talked about this. Get finance to sign off on the formula, the inputs, the time period, inclusions and exclusions. Store the documentation in a shared doc. That documentation methodology is what prevents drift across reports and what gives stakeholders confidence that the number is defensible. Without it, every conversation about LTV becomes a debate about how it was calculated. And again, here, we're coming back to the deciding about your methodology is applying all of these LTVs to products, cohorts, aggregates, all of that, right? So the second is about data infrastructure. How do you actually source these things? Look at all these metrics, okay? Average revenue per customer, gross margin, specifically customer churn. How are you documenting customer churn? Where does that live? If it lives in your CRM, it's got to be highly custom, or it should be in some kind of customer engagement software. But at the end of the day, there's really no getting away from the need for a data warehouse if you want to surface all this information. A data warehouse like Snowflake connected to some kind of BI tool. Okay. So you want to build models in the data warehouse that compute LTV by segment, by cohort, by channel, and by tenure. So source revenue from the billing system, source retention from the customer success platform, source margin from finances, and use a data ingestion tool for source loading, because you're going to need all that data to calculate an appropriate or an accurate number, rather. The third track is segmentation. So you want to calculate and report LTV by SMB, by mid-market, and by enterprise at a minimum. You want to add channel level LTV through attribution data from the attribution platform. Add cohort level LTV that tracks how acquisition cohorts actually mature over time. The segmentation is what produces actionable insights. Otherwise, you have this disaggregated number, or rather the opposite. Rather than you have an aggregated number that doesn't reveal to you the segmented specifics that allow you for appropriate investment reallocation. The fourth track is dashboarding. So you want to build the LTV dashboard in the BI tool that surfaces that LTV alongside CAC payback, and retention. Again, you want to refresh that quarterly with a fresh cohort data, make it visible to marketing, make it visible to sales, make it visible to customer success and finance leadership. The pairing of LTV with the rest of the unit economics metrics is what makes it useful. The fifth track is planning integration. So push LTV projections into the planning tool's financial models so forward-looking plans reflect the segment-level economics. The integration is what makes LTV influence capacity planning and investment decisions rather than just appearing in respective reports. And then the sixth track is operational decision discipline. So use LTV in channel allocation reviews, pricing decisions, customer prioritization, and CS engagement intensity calls. So the metric should drive decisions, not just appear in reports, and build the meeting cadences and decision templates that require LTV on the table for relevant decisions. So here are some insights we can extract. Then we'll get into action items. Insights. You can see LTV by acquisition channel. So different channels produce customers with very different LTVs. Paid search may produce an SMB skewed customers with 20,000 LTV. Outbound prospecting may produce enterprise skewed customers with a 500,000 LTV. The channel level data informs where to invest beyond simple lead volume or cost per lead analysis. Number two, you can see LTV by segment. So the headline revenue segment is not always the highest LTV segment. A segment with moderate revenue but exceptional retention may produce a higher LTV than a segment with high revenue and weak retention. So the segmentation reveals patterns that aggregate analysis hides. Okay. Our third insight is that you can see LTV trends over time across cohorts. So cohorts acquired in different periods produce different LTVs. So improving your LTV across cohort signals that retention and expansion are getting stronger. And a deteriorating LTV signals structural problems that need investigation before they compound. Fourth insight is that you can see LTV by segment and channel, and that ratio analysis validates which motions actually work. For example, segments where the ratio is above 3x deserve more investment, obviously. Segments that's below 2x need either fixes if fixable or de-emphasis if structural. The data prevents the common error of investing based on revenue rather than based on unit economics. And LTV is a core unit economical metric. And then fifth, for our insights, is that you can see the LTV impact of expansion programs. So customers who expand have 3 to 5x the LTV of customers who do not, depending on the magnitude of expansion. So quantifying the LTV lift from expansion makes the economic case for, let's say, CSM, Customer Success Manager investment, through the customer success platform in concrete terms. This is a common SaaS wisdom at this point that, it costs 10 times as much to acquire the customer than it does to keep and expand a new one. And the value of a customer that expands, as we've just seen, is 3 to 5x one that doesn't. So investing in expansion is huge. And then finally, action items. So action item number 1, document LTV methodology in a shared document with a finance sign-off. So specify the formula, the inputs, the time period, the inclusions, and the exclusions. Make this canonical reference that any LTV report points to. Next, build models in the data warehouse that compute LTV by segment, which are by channel, cohort, and tenure. You want to source those, again, from the billing system for revenue, from the customer success platform for retention, and from the finance system for margin. Third action item is you want to build the LTV dashboard in the BI tool that surfaces LTV alongside CAC payback, and retention with full segmentation. You want to refresh that quarterly, make it visible to marketing, sales, customer success, and finance leadership. Next, pair LTV with CAC in every report that actually touches unit economics. The trio of LTV, CAC, and CAC payback together gives the unit economics picture. So build the reporting templates that actually, or rather that automatically include all three. And then finally, use LTV in channel allocation reviews. This means pricing decisions, CS engagement prioritization, things like that. You want to require LTV by channel data in marketing budget conversations. You want to include LTV impact projections in pricing changing reviews. And you want to review LTV by segment data in CSM booked allocation decisions. Okay. So those are our action items. And just to tie this back one more time, back to our formulas, LTV is not a simple number. You have simple LTV, margin adjusted LTV, discounted LTV, and expansion adjusted LTV which is segmented across cohort, product type, tenure, and channel, acquisition channel. And this allows you to make investment decisions. And each of these things allow you to bring a different frame or a different import for the value of your LTV calculation to different conversations with different teams. So once again, LTV is the total revenue of a business LTV is the total revenue that a business expects to earn from a customer over the entire relationship. And broken down and segmented across all of these different dynamics and these parameters is what gives you a really healthy LTV practice in your RevOps organization.